Oil plunged more than 10% yesterday on renewed hope for a Middle East peace deal, dragging bond yields lower across the globe ahead of this week's critical Federal Reserve rate decision. But the technology headlines on the wire were just too ugly to cheer investors up because the Chinese rivals actually rattled the semiconductor sector, whether we are talking South Korea, the US, or Amsterdam, while Nvidia struck a nerve by reviving fears over circular AI financing deals just days before big technology goes to the earnings confessional, potentially announcing another round of ballooning AI spending, shrinking free cash flow, and fresh equity and debt issuance. So welcome to Swissquote's Daily Market Talk. It's Tuesday, 28th of July. I'm İpek Özkardeşkaya. We will talk about the next days and weeks' challenges for investors and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
Oops, it happened again. US crude tanked more than 11% yesterday after the US suddenly stopped its attacks on Iran, and US President Donald Trump said that there was a good chance of reaching a peace deal with Iran. And oil extends losses this morning with US crude trading near $82.50 per barrel level and Brent crude near $85 per barrel mark following a more than 13% pullback yesterday. Fun fact, Iran denies that talks are taking place. So there is a better chance, I would say, that Trump's latest statement is just another empty promise, much like the umpteenth previous pledges to end the war in Iran and reopen the Strait of Hormuz to let these ships sail through. But whatever it is, the retreat in oil prices yesterday are pulling the global yields lower, making me think that, well, Trump's statement was just another verbal intervention to stop the spike in US yields, even though it means just a temporary relief. But indeed, the US 10-year yield is down from the previous 4.70% peak, and the US 2-year yield that best captures the Federal Reserve rate expectations pulls back to 4.30% level as the Federal Reserve starts its two-day monetary policy meeting today. Now, this is the second FOMC meeting under the new Fed governor, Mr. Kevin Warsh, and in his first meeting, remember, Mr. Warsh refused to add a plot to that Fed dot plot and refused to make any predictions regarding the future. And in this meeting, some people expect him to push for a partially priced rate hike to cement the idea that the Federal Reserve will no longer pursue the forward guidance strategy, but rather reinforce its credibility. As an economist, I think that provided the extreme uncertainty in the geopolitical landscape that has major implications for macroeconomic data, well, Warsh's strategy to stop trying to guess sounds about right. So it is actually possible that the Fed delivers a partially priced rate hike this Wednesday. And the partially priced nature of a potential rate hike tomorrow could eventually spoil the markets as the liquidity runs thin in summer months. Activity on Fed funds futures assesses only around 38% chance for a rate hike to happen this week. I actually still believe that we will see that first Warsh hike in September still, just to interact with the markets at a better liquidity time. But I am not ruling out any other options. So the options are open and risks are tilted both sides. Anyway, the softening yields on Monday could hardly improve the mood among technology investors. That's something I think is important to note. The mood there was rattled by three distinct news. One, as we talked about yesterday, the Chinese memo chip maker CXMT made a massive market debut in Shanghai. We are talking about nearly $10 billion worth of IPO with a more than 500% rise in the first day of trading. Even though it will take time for foreign investors to gain access to this stock listed on a mainland exchange only, the fact that CXMT will pressure other chip makers' pricing power is already sending shivers through some of the market's hottest chip stocks. And yes, I'm talking about Kospi, that has become the benchmark for two Korean memory chip makers, Samsung and the very SK Hynix, and that index tanked 10% today in Korea. 10%. The Korean index has already stepped into the medium-term bearish consolidation zone earlier this month, remember? And it's already shed a third of its value in about 6 weeks' time. And the past year's bubble now looks to have burst, so we can officially call it a bubble now. Moving forward, the chances are that this pullback will continue. Then 2, ASML, which has been the world's only company to produce the most advanced chip-making machines, tanked more than 8% in a single session in Amsterdam yesterday after the information reported that a Shanghai-based company with no name for now, hasn't been mentioned, but that company, whichever it is, has started making immersion deep ultraviolet lithographics tools. In other terms, they started making advanced machine makers. And obviously that would be a nightmare for the Dutch ASML because it would mean that the company will no longer hold a monopoly position. And worse, it will face Chinese competition. God help them. And 3, well, this one has nothing to do with the Chinese. The circular AI deal fears are forcefully back since yesterday after Nvidia said that it will guarantee up to $250 billion to help OpenAI lease a data center project in Ohio. Also, they said that Nvidia is considering financing the purchase of $350 billion worth of Nvidia chips for OpenAI. OpenAI, on the other hand, will likely postpone its plans to go public this year amid a mounting market and investor stress over the circular AI deals and the ROI and excessive capex pour into this AI infrastructure, eating also into the hyperscalers' free cash flow that make all these investments, obliging them to issue stock and debt to finance the extra spending. Also in an environment of rising interest rate expectations due to the Middle East and Ukraine war. So we are not at all in a market that could absorb another big IPO like OpenAI's. But coming back to Nvidia, the market reaction to Nvidia news was swiftly negative yesterday. The company's stock price fell 5% and closed the session below the $200 per share psychological mark. But more importantly, Nvidia's 5-year CDS spiked on the news, suggesting that it may not yet be a good time to buy a dip anyway. Because looking elsewhere, well, the situation is not better. The circular deal and rising leverage worries creep in again. Big technology's 5-year CDS are rising too, along with Nvidia's, with Meta leading the worries among the big AI spenders as the company spends without a clear strategy other than try not to fall out the AI race, while Oracle's 5-year CDS, which has become the barometer of AI stress or AI leverage stress, is now higher than the March levels. So that gives you a clear idea on how hard it will be for the big technology companies to prevent a further sell-off this week when Microsoft, Amazon and Meta will go to the earnings confessional and probably announce more AI spending that will have to rely on more stock and debt issuance, and that's going to increase the leverage on their balance sheets. And the numbers are already very much worrying indeed, because together Alphabet, Amazon, Meta, Microsoft and Oracle, these 5 companies already raised more than $300 billion by selling equity and bonds this year, according to S&P Global Market Intelligence. So that is already 3 times more than the entire 2025 issuance, and we are just end of July right now. Then Alphabet last week printed investors' biggest scare in negative free cash flow in the second quarter of this year due to that massive spending eating into its cash. And digging deeper, Nikkei warned last week that the so-called hyperscalers may have some $1.65 trillion. Yes, there is no mistake, $1.65 trillion in hidden debt. So that's off-balance sheet obligations such as lease commitments, for example, that don't need to show up on regular accounting sheets, but they still exist. So in summary, that's a lot of cockroaches that investors should be dealing with in the coming days. It feels like whatever the big technology announces this week, investors will be hard to cheer up. So as I said last week, damned if you spend and risk falling behind the AI race, and damned if you don't, as softer spending growth would be sending a twister on the entire AI supply chain stocks and would not be received as good news by the markets. The only good news here is that a period of price pullback always creates opportunities. The challenge, however, is to spot the next big wave. Is it going to be copper miners, electricity providers, networking specialists, or the new companies building tomorrow's AI infrastructure? Where are we going to see the next big AI wave hit the shore? Time will tell. So I will leave you with that question today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.